Hey, welcome back to our second quarterly market update, where we talk to you about 5 of the biggest things that happened this last quarter in the market and what they mean for you and your business in about 5 minutes flat. Let's kick it off with number 1, something that we're all feeling, a changing economic paradigm that warns of recession. In the last market update, we talked to you about how inflation is on the rise, passing highs of the last decade or so. But in the last 3 months, we saw that impact reverberate across the economy, with GDP growth slowing, spending coming down, and ultimately the Fed hiking rates up by 75 basis points, or the largest update that we've seen in the last 28 years. Why? Well, because if inflation gets too high and the dollar suddenly isn't worth what it was worth yesterday, that's going to create a number of challenges for Americans. It'll be harder to buy basic goods like gas and food. It'll be harder to make investments in homes, and the value of assets will also change. And that's why the Fed is using interest rates as a lever to try and curb inflation. But it's going to be important as the Fed navigates the upcoming 18 to 24 months for them not to push that too hard, as the downside effect could be slowing growth so much that it actually makes the recession worse. This will be a delicate balance, but it actually ties to theme number 2, which is a broader pivot to profitability within the investing and fintech markets. Let's be honest, for the last 5 to 7 years, we've seen one of the biggest bull runs in history, as different companies have cropped up trying to solve different problems for consumers and businesses nationwide. Over the last 5 to 7 years, companies were rewarded for one thing, and one thing only: growth. Could you take the dollars that you raised and use that to acquire users, and use that to get another set of funding that you would use to then acquire users? And for a while, it made sense. Companies looked at other companies like Uber and the like, and had a mantra of, if you grow it now, you can get profitable later. Well, in the wake of the macroeconomic conditions, investors and fintechs alike are starting to focus away from growth and towards profitability, because ultimately the thing that keeps a business sustaining itself is being profitable. So you don't have to raise that next round. You can choose to accelerate your growth, but your business fundamentally can grow itself. That's creating a ton of impacts for fintechs across the industry. For some, like the Coinbases, the Klarnas, and the Robinhoods of the world, we've seen massive sector-wide layoffs, with over 3,000 different people unemployed over the course of the last 3 months. For others, it means looking at existing partnerships and saying, how can I make this more economically efficient? How do I lower my fraud costs, cut out features that I don't need, and ultimately build a winning proposition? And for others still, it becomes about not being everything to everyone and focusing on what they're good at to try and drive profitability and growth in that regard. With IPOs slowing down and fintechs looking inward, this will be a pretty interesting period for a lot of those that came through that initial wave, and expect to see a bit of culling down of those that were built over the last 5 to 7 years, with those that actually have a good business model prospering and growing into the future. At number 3, we have the crypto markets cooling off. Back in November of 2021, we saw Bitcoin at a high of near $70,000. Today, just about 7 months later, that's plummeted down to $29,000. And it's not just Bitcoin. If you look broadly at the cryptocurrency markets, we've seen a decrease in value north of 50 to 60% in most cases, causing investors to ask, is crypto around to stay? And what does this mean for crypto as a means of investment? Ultimately, the value of a cryptocurrency comes down to 3 basic things. Ubiquity, so how much is it actually used? Utility, is it useful and does it solve for a specific use case? And perception, how does the community think of it? Because that's going to change how people adopt it as an asset or as a currency. For cryptos like Bitcoin and Ethereum that have found a use case, that have found ubiquity, and that generally have a positive perception, you're going to continue to see downturns, but it's likely that those are around to stay as they're filling a spot in the overall economy. But when you look at cryptocurrencies like Terra and Luna that promise something fundamentally impossible and ultimately failed, the end is not quite so pretty. So for those looking to invest in crypto, don't try and catch a falling knife and time the market bottom. Likely just dollar cost average into the ones that actually have those 3 areas, and though it may go up and down, you're less likely to lose all your money. At number 4, we have BNPL, continuing to grow, albeit at a slightly reduced valuation. Over the last 6 months, we've seen the stocks of BNPL companies like Klarna and Affirm plummet by north of 80%, as the market starts thinking of them more as financial firms and less as technology firms. That was exemplified in the recent Klarna round, which was a down round, decreasing the valuation by almost 80% in order to help the company to grow. Now, that doesn't mean that BNPL is necessarily bad. It can still bring credit to a crop of consumers that need it in a way that isn't necessarily predatory. But it's really important for BNPL companies to focus on driving profitable businesses, and also to focus on not bringing BNPL into areas like pubs and bars, where they're fueling unproductive means that'll ultimately just hurt the consumers at the end of the day. At number 5, to close us out, we see a waning demand of consumer fintech amongst the investor community, but a rise in embedded finance. Between 2021 and 2022, embedded finance was the fastest growing and the most funded area within all of venture capital. And looking at firms like Pegasus Tech Ventures, Martin Tantow talks about how ultimately the next phase is not going to be a consumer-facing digital bank or a consumer-facing crypto wallet, as we've seen several of those out in the market. Embedded finance is what is interesting for them, because that's what's enabling this next crop of companies to build these types of solutions. Now, don't get me wrong. All that glitters is not gold. Those that wrap legacy technology, while they may get you to market quickly, are going to struggle as it comes to actually innovating and scaling those stacks. But on the flip side, it takes a lot longer and a lot more effort to build those stacks from scratch. So over the next 3 years, expect to see a similar type of evolution in the embedded finance space that you've seen in the consumer space. Namely, those that have built a competitive advantage, that actually scale, and that have found a way to distribute properly into the right kinds of companies will succeed, whereas those that maybe wrapped legacy technology and tried to just get a quick path to market may start to have some challenges. So all in all, pretty eventful quarter. We saw the beginnings of a downturn that we'll all begin to navigate. That changed the way that companies and investors are thinking about financial technology. Ultimately, everybody is focusing on serving the consumer and driving profitability, and those that do that well will succeed, and those that don't will unfortunately not. What are the next 3 months going to look like? Well, it's only one way to know. Live it. We'll see you at the next one. Thanks.